Good morning, Jerry. Good morning.
Yes, a very good morning to all of you, our distinguished invited guests who have joined us online. Thank you very much for joining us online this morning for GSE's Fund Behind the Figures to be presented by CalBank PLC. So we will start the program with an opening prayer to be said by Ms. Martha Akwe, who is the head of customer experience at CalBank. So let's invite Ms. Martha Akwe, head of customer experience at CalBank, to kickstart the program with an opening prayer.
Let us pray. Please close your eyes. Father God, we thank you for today. We thank you for the gift of life. We thank you for bringing us together virtually for this important program. We ask the Lord, you come and be in our midst, be in the discussions. We ask that deliberations will be useful to us, to our stakeholders. And at the end of the day, Lord, we'll come back to say thank you. In Jesus' name we've prayed. Amen.
Amen. Thank you very much, Martha. So once again, on behalf of the Deputy Managing Director of the Ghana Stock Exchange, Mr. Frank Bell, I welcome all of you to today's Fact Behind the Figures program. Fact Behind the Figures program is a program that has been designed by the Ghana Stock Exchange for listed companies and issuers to update their stakeholders on their performance, the trends in the market, and their plans going forward. And today is the turn of CalBank PLC, and we are glad to have the Managing Director, Mr. Carl Assem, and his executive team to do the presentation. But before we go ahead, I want to also introduce to all of us the team from the exchange that are joining us. So we have the Deputy Managing Director, Mr. Frank Bell. We have the Head of Strategy and International Relations, Mrs. Nina Okine. We have Mrs. Joyce Esibuachi, Head of Listing and New Products. We have Mr. Eric Edifo, who is the Head of IT. We have Mrs. Eileen Norte, who is the Head of Admin and HR. And we also have Head of Legal and Compliance, Mrs. Antoinette Yairate, and then Head of Finance, Mr. Charles Dixon. I also want to acknowledge the team from CalBank. So I want to acknowledge the Managing Director, Mr. Carl Assem, the Deputy Managing Director, Mr. Johnson Owari, Mr. Kwame Dansu, the Business Manager and Chief of Staff, Mr. Kojo Arizie, who is the Head of Corporate Banking, Mr. Stephen Essien, Head of Consumer Banking, Mr. Michael Edu Brafo, Head of Commercial Banking, and Ms. Martha Kwe, Head of Customer Experience, Mr. Andy Siedu, Head Depot, and Madam Difa Yasapo, who is the Head of Credit, and Mr. Joel Namdan, who is the Head of Recoveries at CalBank. So I will now introduce the presenters for today, and we'll start with opening remarks from the Managing Director of CalBank PLC, Mr. Carl Assem. So we invite you, sir, to give us your opening remarks. Thank you.
Good morning, Jerry.
Good morning, Mr. Assem.
Good morning, distinguished guests, the Deputy Managing Director, the leadership of Ghana Stock Exchange, the esteemed members of the media, colleagues, ladies and gentlemen. It is a pleasure to welcome you this morning following what has been a strong start to our 2026 financials, one that reflects not only the resilience of the franchise, CalBank, but also the discipline and intentionality and clarity with which we continue to execute our strategy. At a headline level, the numbers speak for themselves. However, beyond the figures lies a much more important narrative, one that speaks to the deliberate, sustained transformation journey that CalBank has undertaken over the last few years. This is a story of resilience, a story of rebuilding, and a story of renewal and growth. It is the story of a bank that has moved decisively from a capital constraints to a position of robust capital adequacies, underpinned by successful recapitalization and strengthened balance sheet that is supporting a new growth phase. This story has led to a disciplined risk management of a transitioning credit vulnerability balance sheet to a more balanced and prudently structured book, reinforcing a robust corporate governance, dealing clearly with a non-performing ratio, and being on track to meet all regulatory compliance in that area. The story of the CalBank has also led to diversification of moving from concentrated income streams to a more resilient and sustainable earnings profile, both from our funded and non-funded income lines. Our growth is no longer dependent on a couple of levers, but it is a broad-based, resilient, and increasingly stable performance. Reviewing it from a rebuilding and growth, there's clear emphasis on efficiency, stability, and cost optimization. Prioritizing sticky, low-cost deposits that enhance our margins and position us to be a better bank, withstanding all external shocks and economic cycles. It is a story of scaling up our presence in the retail and SME segments of the Ghanaian economy, sectors that offer the greatest potential for broad-based economic impact by leveraging our strength in technology and digital innovation. We are deepening our customers' engagement, enhancing convenience, accelerating financial inclusion in a way that is both scalable and impactful. It is finally a story of restored market confidence. In less than 6 months, the market has responded positively to our progress, with our market capitalization more than tripling what we were some 6 months ago, reflecting growing investor belief in strength, direction, and sustainability of our business and franchise. Our CFO will shortly take us through the numbers in details, and will give us some time for us to engage more deeply on the facts behind these figures. But there's one key takeaway I would like to leave with you this morning as the stakeholders for CalBank. This is just not a story of improved performance in a single quarter. It is a story of a bank that has fundamentally reset its foundation and is now firmly on a path for sustainable high-quality growth with clear trajectory to delivering enduring value for our shareholders and all other stakeholders. On that note, I would like to thank you all for making the time to be here with us this morning, for your continued interest and support to CalBank PLC. We hope you find this session insightful and engaging. Thank you very much.
Thank you very much, Mr. Kalasem, the Managing Director of CalBank, for the initial remarks. We also want to acknowledge Mr. Douglas Isia, Head of Management Information Systems, Mr. Albert Ganza, the Chief Technology Officer, and Mr. Sadiq Arthur, the Chief Risk Officer, and Mr. Blaise Hene, the Treasurer. We will now hand over to Mr. Joshua Dente, the Financial Controller of CalBank, to take us through the presentation. So over to you, sir.
Thank you, Jerry. Thank you, MD, for your opening remark. The Deputy Managing Director and members of the executive of the exchange joining us today virtually, my colleagues from CalBank, our valued shareholders, partners from the capital market, including fund managers and brokerage firms, members of the media, good morning and thank you for joining us today. Colleagues, I recall the last time we convened for our Fall Behind the Figures session, we made very clear and deliberate commitment to you that CalBank would bounce back. Specifically, we committed to restoring our capital position and ensuring that this proudly indigenous bank remain resilient, relevant, and firmly positioned for the future. Today, I'm pleased to say that we have delivered on that commitment. This morning, I will take you through the operating environment, both macro and sector dynamics, followed by an overview of CalBank, which I call business update. I'll then walk you through our financial performance for the first quarter of 2026 and conclude with the key strategic priorities we are executing as a bank to sustain and build the momentum for the remainder of the year 2026. Let me briefly walk you through the macro backdrop for Q1 2026. The economy continued to stabilize. GDP growth rate forecast for 2026 is pegged at 4.8%, moderating from the 6% that we did last year as an economy. And that reflects a very strong and resilient recovery path. But most importantly, growth remains service-led, contributing about 46% to GDP, with the financial service sector continue to play a very significant role, very central role in the economic activity of the country. On the monetary side, we are seeing a clear shift. Inflation has declined from the peak levels, and this allowing for the Bank of Ghana to gradually ease the policy rate. This positive signals is good for the banking sector, and that will support low funding costs and also a recovery in credit creation, particularly across the SME and the consumer segment. We as a bank are very ready for this as well. On the exchange rate, we note that there has been some relative stability compared to the prior period of volatility that we witnessed. That said, we are very mindful of the FX dynamics, and an important watch point that gives us possibly some sleepless night, but it's a watch point that has implications for asset quality and capital in the future. On the fiscal side, the deficit has narrowed significantly by 1%, as we can see, reinforcing that macro stability that I mentioned earlier. We see public debt to GDP ratio also ease, improving significantly from a 61.8% to 45.3%. At the same time, we also see treasury bills decline sharply from the high levels of 17.15% on the short end to a 4.75% as at the end of the first quarter. And this shift is very critical. So net on net, we are moving from a period of constraint into one of expansion, with the right condition now in place for loan growth, margin recovery, and a stronger earning delivery going forward. Looking at the sector, the banking sector, the growth path is very clear. Total assets have expanded significantly, and as at the end of February, we see a 465 billion in total assets, and deposits also have increased significantly to 338 billion. And this actually reflects a very strong liquidity and continued customer confidence in the banking system. However, the data show that loan growth, while improving, remains relatively more measured, with gross advances at 108 billion, highlighting that the sector is still transitioning from a more of a risk-off posture to a more of growth-oriented stance. The key point here is that the capacity to lend is firmly in place in the market because liquidity is strong. The balance sheets are expanding and capital position have improved post-recapitalization across the sector. Also, what you are saying is that this is quite critical for credit creation, and this will be done to improve margins as well. So as a sector, we are moving into a phase of liquidity abundance, and it's clear on the market what's currently happening, and this will be supported and a constraint shift from capacity to execution. As a sector, we now have the capacity to execute. We now have the capacity to grow the loans. The fundamentals of the sector has remained very strong. We see solvency levels improve, with capital adequacy level of the sector improving to 18.6%. And this is comfortably above the regulatory threshold. And this reflects the success of the capitalization effort that the industry have undertaken over the period to support the phase of credit expansion. Also, on asset quality, we note that NPL ratios have improved significantly from the 21.8% levels to the current 18.7% as at the end of February, indicating that the asset quality cycle is likely behind us as a sector, and although recovery remains a gradual and a disciplined way. Also, when you look at the efficiency ratios, it has improved significantly. Currently, we are talking about 74% when it comes to our cost-income ratio as an industry. I'll move on to my next slide. That's talk about the business update of the bank. And those of you joining us for the first time may want to know what CalBank represents. CalBank is a well-established indigenous bank with over 3 decades of operating history and a strong national footprint. As at now, we operate more of a hybrid model with 38 branches, 93 ATMs, and over 2,478 agents, which give us both scale and reach across key economic regions of Ghana. And this is complemented by very trained professionals, over 782, who are effectively executing across our business segments. Strategically, our plan is to transition to a Tier 1 bank with a deliberate push to deepen our retail and digital presence, anchored on innovation and customer centricity. From a shareholder perspective, we maintain a very diversified and stable ownership with strong institutional backing. And this was highlighted during our capital raise. And most importantly, we have very good products, with stable digital capability from retail segments, SME lending products, which enable digital channels, including internal banking, mobile solutions, and onboarding. CalBank has been in the market for a while, over 30 years. As our close of business yesterday, our market cap now stands at 3.6 billion, with a positive year-to-date performance on the market at 34.38%. This is the story of CalBank, and this is an indigenous bank. I'll proceed to the reason why we are here today on the financial result of the bank for the first quarter of the year 2026. We delivered a strong performance in the first quarter, with profit before tax increasing by 156% to 164 million cedis. This performance was driven by a broad-based income growth, as you can see, across both interest income and non-interest income lines. Our NII almost doubled, up by 98%, while non-funded income grew by 89%. And this is supported by higher transaction volumes and trading activity in the first quarter of 2026. On the balance sheet, we continue to see a steady growth. Deposits have increased by 11% to 10.4 billion. Total assets grew by 13% to 13.4 billion, reflecting that confidence that customers have in us as a bank, and also improving our liquidity. As you all are aware, 2024-2025, we embark on a journey to restore our capital. Through this, we strengthen our capital position, and as we speak, with a capital adequacy ratio of 17.2%, giving us room to actually support future growth. But most importantly, asset quality is improving, with our current NPL ratio declining to 15.1% as a result of strong recovery efforts that we have undertaken. As we remain focused on earning resilience, just as the MD mentioned, we also recognize the need to progressively expand the loan book with a strong bias towards quality assets and a disciplined risk management. I will now transition to give you more details on our performance at the operating income level and our profitability. In the quarter under review, the first quarter of 2026, our total income increased significantly to 326 million, with a net profit rising to 107. And this is a strong rebound compared to the prior period, as we can see. And most importantly, this performance was driven by a broad-based income, just as I mentioned earlier, and not just concentrated. Net interest income reached 171 million cedis, while non-funded income also grew to 154 million cedis, showing quite a balance across both core income lines. This is a key shift for us as a bank, because we are no longer reliant on a single income stream. Earnings are now more diversified and sustainable, and MD stressed that in his opening remarks. Our efficiency ratio, as you can see, has improved. Our cost-income ratio declined sharply to 50.7% in the first quarter from the elevated levels the last year. This was deliberate, and it was as a result of the cost discipline and operating leverage coming through our revenue scale. From the operating performance and profitability level, the takeaway from here is very simple. The bank has actually moved from a recovery to a sustained performance. Building on this, I would like to break the quality and the drivers of our Q1 earnings. First, on income composition, our NII accounted for 53%, while our non-funded income contributes 47%. And this was a building block, and this started in 2024, where we saw our non-funded income to our total operating income from 42% to a 47%. And This shows that our earnings now as a bank is well balanced and more resilient. The key here on this slide is how sharp we have improved on our net interest margin. Our NIM increased to 6.4% to 3.1% from 3.1% compared to the prior period. And this is effectively a doubling. And it reflects both improved funding mix, and I'll explain that in my later slide, and an overall balance sheet efficiency that we as a bank have undertaken in the past couple of years. This is important to us because it signals that we are not earning more on every cedi of assets, which is fundamental driver for a sustained profitability. And this improvement, just as I mentioned earlier, is very visible in the numbers as I've shared with you. Seeing our NII for the quarter move to 171 million cedis, the first time in so many years, if you look at the history. Also, across the business segments, income remain well diversified. Treasury contributing their parts, consumer and commercial banking contributing their quota, as well as corporate banking. Also, you will note that our cost of risk remain negative. And this is as a result of the recovery efforts that we have embarked on since 2024. The bank, just as I mentioned earlier, has moved from a recovery into a sustained performance. Let me also walk you through our earning asset portfolio. Starting the loan book, our net loans stand at 1.1 billion. Yes, we acknowledge that the loan book remains below the optimal level as a bank. And our focus now is on rebuilding it in a more disciplined manner, firmly within our risk appetite. We want to be very, very deliberate about it. We want to prioritize asset quality, risk-adjusted returns, and sustainability, rather than pushing and pursuing a growth for its own sake. And as you bear with me, as the macro environment improves, we are well positioned to gradually build this book back. From a sector perspective, the portfolio remains well diversified. Our goal is to dilute the concentration in the construction sector with services and commerce, as well as agribusiness. On the other side of the earning portfolio, we maintained a liquidity-first capital preservation strategy during our recovery phase as a bank, with exposure in short-term exposures, first placing funds with the Central Bank of Ghana. And also you know that the chunk of our investment portfolio is concentrated in the DDP bonds, where we're largely exposed when that happened in 2022. On capitalization and asset quality, our NPA ratio has improved significantly from a 45% in 2024 to a 15.1% as at the end of the first quarter of 2026. And this was on the back of a sustained recovery effort we have embarked on since 2024. While still above the short-term targets that we've set for ourselves as a bank, the direction and travel is very clear. Asset quality is improving and stabilizing. Our aim is to achieve the regulatory threshold of 10% by year-end 2026. On the back of a successful capital raise and a deliberate balance sheet restructuring, the bank has also moved from a negative capital position in 2024 to a strong capital adequacy ratio of 17.2% as at the end of the first quarter, well above the regulatory requirement of 13%. Most importantly, it provides us the capacity to support future growth, specifically the loan book. When we come to our funding and liquidity position, customer confidence and franchise strength has sustained this bank, and that cannot be overemphasized. Our total deposits have grown steadily from the 6 billion levels in 2022 to a deposit of 10.4 billion as at the end of the first quarter of 2026. But most importantly, the quality of deposit remains strong at a high cost of 89%, supporting the low cost and funding structure that we have now and a margin expansion. From the funding perspective, the mix is very interesting. As we can see, the mix is dominated by deposit, as we've deliberately reduced reliance on borrowings and a strengthened capital position at giving that liquidity. This also reflects in a more stable and a self-funded balance sheet. We want to fund the balance sheet from deposits. We want to fund the balance sheet with the liquidity that we have from the capital that we raise. Overall, our liquidity position remains robust, supported by a strong deposit base and a very conservative funding structure. This is something we want to keep going into the future. Now, let me move on to how we expect the rest of the year to look like. And I want to close my presentation outlining how we are going to translate our Q1 performance into a sustained growth. First, we are driving retail and deposit mobilization to sustain a low-cost, stable funding base. This is critical to us as a bank to sustain the margins and support growth. Second, we are scaling payments, cash management, trade and digital platforms, not just to grow volumes, but to accelerate fee income and deepen customer engagement. Third, we are expanding unfunded income as a core engine of our earnings. As you have seen our Q1 numbers, this is already contributing close to half of our income in terms of diversification and earning quality. Fourth, we are taking a disciplined approach to rebuilding the loan book with a focus on SME and the consumer segments, while staying firmly within our risk appetite. And finally, what we've done best in the past couple of years is to continue to embed a rigorous cost discipline, driving efficiency and ensuring that revenue growth actually translates into a strong operating leverage for us as a bank. We want to move from a recovery to a more sustainable growth. Thank you very much, Jerry. I'll end my presentation here as we move on to the next phase of the engagement for today. Thank you very much.
Thank you very much, Joshua, for that elaborate presentation. So we will now go to the next phase of our program today, and that is the Q&A session. So now the floor is open. If you want to ask any question, you can put it in the chat box, or you can raise your hand and they will call you to ask the question. So, ladies and gentlemen, our distinguished invited guests online, it's now time for questions and answers. If you have any question or any comment with regards to the presentation, please, you are free to do so. I'll start with the chat box. It looks like there's a question in the chat box. So I'll start with that one and then give the CAL executive team the opportunity to respond to these questions. So we have the first one from Pabna Asante Obeng that says that congratulations on the capital raise and a strong Q1 2026 results. We are glad to see CalBank stabilize. However, the stellar Q1 2026 performance is partly boosted by a low base from the same period the prior year. Given the interest rate environment, the bank will have to really sweat its balance sheet to generate income beyond the non-funded income support. Will the bank push the envelope on loan portfolio, especially as NPLs sit above the BOG's target of 10% by end of 2026? If not, what should our outlook in interest income be? So maybe let me add the second question so can respond to it. So Grace Monanyam is also asking. So she said, well done to the bank for its impressive results for Q1. And her question is, the group recorded 52% decrease in loans and advances, but interest income surged significantly, while investment in securities wasn't so big. The question is, was the interest come resulting from one, loans recovered, and what percentage went into this interest income? The second is restructured loans or bad debts that were written off. So please, you can take these two questions and then we'll continue. Thank you.
Thank you, Kwapna and Grace, for your questions. We clearly, as part of our research, we look at our book, make sure that we dealt with it properly. Loan growth is our agenda, but prudent loan growth is purely our agenda. We have made sure that as we started growing our loan book from January, we are mindful of a disciplined approach with risk alignment and SME focus. We have started seeing growth, but as you are mindful of that, our lending rates have crashed. But based on that, we are also growing the volumes. You will see that growth that will address also the NPL ratios as well, and will be fully aligned with Bank of Ghana by the end of the year. That I can assure you. But we are not just growing loan for growing sake. And that is what the CFO has indicated. And this is something that we mean, because our risk management and the governance purposes are very critical in that growth. And we are taking our time to make sure that we grow. Today, although the lending rates have crashed, we still look at the credit profile of our customers to make sure that our pricing is right. And that is also something that we are fully looking at. So I can assure you that you see growth in interest income coming from loan. The loan growth of where we are today and looking at the horizon will definitely grow. You see that loan growth, but we can assure you that these are growth that are done prudently, risks being properly managed to ensure that they will never translate into a non-performing loan zone. So that's what I can assure you, both Grace and Kwabena. The loan that we have seen and the growth I have seen are purely loans that we have booked. we have also done a lot of contingency supporting SMEs on the working capital needs of their businesses. And that is what makes us relevant into the economy that we are operating in. We keep on doing that both on the direct loans and the contingency. So we see growth in those areas as well this first quarter, and it's something that we continue to pursue. Thank you.
Yeah, thank you. Okay, so there's a question from Joseph Sam. Okay. CalBank's share price has declined approximately 15% since early March, despite the broader GSE composite index gaining over 50% year to date. With the Bank of Ghana policy rate to 14% in March and inflation at 15-month low of 3.2%, the macro environment appears supportive for banking sector recovery. However, escalating Middle East tensions have pushed oil above $100 barrel, raising imported inflation risk and potentially reversing Bank of Ghana's easing trajectory. Can management provide specific guidance on how Cal's loan book and NIM are positioned if the Bank of Ghana is forced to pause or reverse the rate cuts in half year 2026? And what proportion of the loan portfolio carries floating versus fixed rate exposure? So that's one question. It's very loaded. So let me add the second question, then you can please respond. As a PLC, I wish to know the bank's management and board members' plan to acquire shares of the same. As at the last AGM, none of the directors held a single stock, which does not give the right signals to investors like myself. Any commitment to make some strides in here? Again, with the competition in the banking sector, with a decline in the monetary rate, can the bank revamp its SMEs support schemes and also come up with some innovations? Thank you. So please, you can respond to these two questions. Thank you.
Thank you very much, Joseph. We are looking at the area. We are fully aware of the policy rate cut. We are also seeing as the trend in our macroeconomic, especially on the inflation and our lending rate as well. And this is an area that we have. For banks to be relevant, it is not only about only giving loans, but being relevant by providing the necessary support to our customers. And those customers, those support are not only giving them loans, which is laudable, but also the advisory services that we offer. We have always made sure that loans alone does not become our only income revenue generation, but the advisory services and the fees and commission that we also render. So we always provide that balance make. For the last 2 years, whilst our loan book was not being grown deliberately because of our challenges, we have deliberately also reinforced our non-funding income approach. And that balance is what will win the game for banks this year. If banks rely on only loans and not able to provide that non-funded income support that the customers need, that will affect it. And that is why CalBank has deliberately positioned itself to be able to do that very well. And if you see our book today, we see that 46%. But that is what we have done the last 2 years, sustainable, always operating a non-income income ratio around 42-43% throughout the last 3 years. And so I can assure you that the first quarter 46% non-funded income is not just a fluke, but it's something that we have deliberately mastered very well. In terms of loan growth, I can see the outlook with growing the loans, providing the necessary support for the SMEs, but deliberately making sure that those loan book are in correlation with our risk appetite. In terms of the directors, if you all knew, we lost all our directors previously last year, and we needed to go onto the market to get new directors to steer the affairs of CalBank PLC. Those new directors, we finally concluded all of them to be on board in January. So they will definitely be taking shares in CalBank, I can rest assured you, in the coming months and years. Thank you.
Thank you. So there's a question from Kofi. Congrats for Q1 2026 performance. How are you positioned to play in the retail sector? Noting that lots of funds are trapped in mobile money wallets of customers across the various service providers. Thank you.
Yeah, thank you, Kofi. As a bank, the last 3 to 5 years, we have deliberately started working on our retail. And we have scaled up on retail, not only dealing with them directly, but also scale up on our digital and technology platform offering to those customers. Today, we are proud that roughly 45 to 49% of our deposit comes from the retail, the individuals. That has cushioned that our base in terms of the contribution that our retail end is. It's an area that we are enhancing each day, finding new products and innovations to be able to do that. The beauty about CalBank is that we are very strong on our digital platform and our technology. And those are the areas that we are using to scale up our retail growth to be able to meet each customers in this country. And you will see a lot of growth in that area as the weeks and the months goes along. Thank you.
Thank you. Okay, so I have a question. So let me read the question in the chat box, then I'll add my question. Then you can respond. So Kwabena Santi Oben is back. He's saying exactly the response to your question, but he's asking again. You say prudent loan growth. Can you define what prudent looks like? First question from Kwabena Asante Oben. And then the second question is, can you give us guidance on the medium-term growth range for loan portfolio? And okay, so these are two questions. Let me add, let me see the third one. He mentioned that there are new directors who came on board in January and they will be taking up some shares soon. Yeah, I think the issue about directors taking up shares, I think Mr. Asem has responded to that. And so we'll not believe at that point. Okay, so please, you can respond to the two questions. Prudent loan growth, what you mean by that in that context, and also any guidance on the medium-term growth range for loan portfolio. Thank you.
Yes, thank you, Jerry. What we mean by prudent, that the bank have taken a step back the last 2 to 3 years, reassess its risk appetite, and ensure that there are governance rules that we have put around it to make sure that all the loans that we are able to give customers are well structured to be ensured that repayment is done, both at the convenience of the customers, but also to meet the bank's objectives. This has been well structured in that way, and we are deliberating growing those loan book in that way, and that is what we call prudent. In terms of our medium-term loan is a critical component of our core business, and I can assure you that that area of growth is something that every day we wake up, strategize, meet our customers, and providing needs. But we are not just growing loans for loans growing sake. I keep on saying we need to be relevant in our customers' business, identify their needs, and whatever support they need to be able to meet the objective that we all identify, that risks that we are correlated with in our way of operating, to be able to grow that. And it's an area of growth that we have always demonstrated in that growth in that area over the past few years. And I can tell you that that area of growth, you will see it growing very strongly in the medium term. But it will be strongly an SME-focused growth that we are pursuing, and that is where our strategy is. Thank you.
Thank you. So there are still some questions in the chat box. So Joseph Sam is asking, fee and commission income has become increasingly important for Ghanaian banks as interest margins compress. Can management quantify CAR's mobile and digital banking transaction volumes year on year And what percentage of operating income is now derived from non-interest revenue? What is the target for that ratio by end of 2026? This question is loaded. And so let me go to the second question. Following Ghana's domestic debt exchange program, what is CalBank's current capital adequacy ratio? And has the bank fully provisioned for its DDP affected bond holdings? Can management confirm whether any residential DDP impairment charges remain to be absorbed in 2026? Or is the balance sheet now clean? So we can take please take these two questions. Thank you.
Mobile and digital banking transaction volumes keep on growing year on year. And as the entire industry figures also continue to grow, we have a sustainable market share. We don't believe that where we are is where we want to be, and we are deliberately growing. But we are always not only doing Momo, but we have our own ecosystem that we are building up on. And that's an area that we see growth with it. Those are the ones that give us part of our annuity income for that growth. So when you look at our non-interest revenue or our non-funded income, we are working around the ratio of 46%. And we strongly want to always be between 42 to 50% at any point in time. That diversified income makes sure that we are not reliant only on interest income of our growth pattern. And somebody asked earlier on, majority of our book on our floating rate, and any change in the macroeconomic, we know we take the upside as well out of it. With regards to capital adequacy ratio, at the end of first quarter, capital adequacy is around 17%. And this is an area that we are watching, but we know that we are very resilient in our tier 1 capital to address that. In terms of DDEP, in 2023, we took all the needed provisions, and the balance sheet is fully clean, and we continue to grow this book with authentic numbers coming out of it because of the resilience and the clearing we have done on the balance sheet in terms of loans and the right provisions being taken. Thank you.
Thank you. Okay, so there's a question here. So please, concerning dividend, CalBank has not paid dividend for some time now. I want to find out when CalBank intends to pay dividends so shareholders will be happy. So this is a question from FB. And then there's also another question. Finally, so it means that this is Joseph Sam's final question. It's not a final question from everybody else. Finally, given the improving macroeconomic environment, declining inflation, a lower policy rate, and cedis stability, does the board have a target timeline for restoring or initiating a dividend? And what capital adequacy threshold will need to be met before distributions to shareholders are considered? So please, you can take these two questions.
Yes. So thank you, Joseph, once again. Paying dividends to shareholders is something that is very dear to the board's heart and the management heart. And for the last 4 to 5 years, we have not paid dividends, and it's something that we are working hard at it to ensure that we deal with it. But as part of our recovery and the growth, we need to deal with our negative retained earnings and be able to be in the position to pay dividends. And it's something that we work hard at it each day to be able to address those shortfalls. And very soon, you will hear of us making sure that we are also giving that reward to our shareholders by giving them the rightful dividends. So it's an area that we are working on to be able to cross that bridge as quickly as possible.
Okay. Thank you. So there's a question from Augustine Hagan. Given that CalBank's major setbacks stem from DDP and the balance sheet has historically been tilted toward investment securities, now that Ghana is moving into a lower interest environment and the recent rights issue has strengthened your capital, should investors expect a strategic shift towards faster loan book growth such that the loan portfolio becomes larger than the securities holdings over time? Secondly, if the bank meets its medium-term profitability and efficiency targets while maintaining strong capital levels, Will management consider capital return options such as share buybacks, or will excess capital remain focused on growth and dividends? And then Courage Marty is also saying, congrats to the team for the stellar performance. The story behind the numbers is very compelling. Okay. And he also said he has some quick questions. But I think, okay, let's see if we can put out these two questions, then we can respond to all the three. So Courage is asking, net earnings have been partly supported by impairment gains due to the aggressive recovery efforts. But how much of the lever is left to be pulled in support of earnings? And the second one is, how vulnerable is the deposit and loan book to FX changes? And are you able to give us any guidance on the FCY, LCY mix for the deposit and loans, that's for both current level and expected? So I think I'll end here for you to respond, and we can go to the other questions.
Yeah.
Thank you.
Yeah. Augustus, thank you for your. In our strategies, the clear strategy that you have had, which I've said earlier on, is to help to support the SME growth, to provide loans for them to be able to augment their business and for that growth and be relevant in their business. That's an area that we are looking at, and we expect that that loan portfolio will grow even higher than our securities holdings that we are holding. And that is where our clear vision is. That medium-term profitability we are talking about and that efficiencies will come from that loan growth as well. In terms of buybacks and also focusing on growth and dividends, I think we are more skewed towards growth and dividends. And we still recognize our shareholders. We still are interested in the retail shareholders that we have in our books. And we want to continue in that area of that. For Courage, the question about the levers that we are pulling to support our earnings, we are using all our entire balance sheet broad base to be able to generate our income. And we are strengthening each of our income stream to be able to do that. So we don't focus on only a narrow-based earning approach, but it's a broad-based earning approach. And that becomes what the bank is propelling itself to be relevant in the business of our customers. And it's an area we continue to do that. In terms of our deposit mix, in terms of FCY and LCY, today I can tell you that we are 71% local currency against a 29% foreign currency. And this is an area that we are watchful and making sure that our balance sheet is skewed towards our legal tender, which is our local currency. And that is an area that we are looking out for. Thank you.
Thank you. So we have a few more questions. So Sylvester Nesprechen is asking, regarding the disclosure on the 1.52 billion written off for woeful defaulters, including the 95 million exposure to Ibistec and 7 other entities, I would like to know the current status of the legal recovery process for these specific assets. Since these debts have already been fully written off and sit at zero on the balance sheet, any successful recovery will flow directly into profit as a gain. Therefore, given the 733 million retained earning deficit reported in Q1 2026, what is management's realistic recovery target for these assets in 2026? And how do you expect these potential inflows to accelerate the repair of the capital position to fast track the resumption of dividend payments to shareholders? Yeah. So you can please respond to this one. Thank you.
Yes, thank you, Sylvester. On our recovery front is something that we are working tirelessly to make sure that we recover everything that is out there that belongs to CalBank. And customers have purely engaged, even all those that are written off every day to make sure that we recover. We have made success gains in our recovery processes. Ibistec and all other things, we are recovering. We are not fully recovered yet, but they are assets we have sold, and we have made sure that those funds have come back to us. We continue to sell assets this year as well to be able to get it. And when all other proceedings are completed as well, we'll ensure that the other 7 as well are recovered. So this is something that is an area that you have seen. If you have seen our balance sheet the last 2 years to 3 years, you see a lot of recovery amount, and we are still pursuing those ones this year as well, and you see growth. Repairing that retained earnings of negative 733 is something that we are working at every day to ensure that we recover. And based on the progress that we have done so far, we'll definitely achieve that. So rest assured, we are working closely with you to make sure that the dividends are paid as quickly as possible. Thank you.
Thank you, Mr. Sem. So there's also a question from Augustine Hagan. Looking beyond the domestic market, does CalBank have any medium to long-term plans to expand beyond Ghana, whether through regional subsidiaries, partnerships, or cross-border data offerings? And what conditions will need to be in place before management pursues that strategy? Thank you.
Yes, thank you very much, Augustine. Growth beyond Ghana, either through digital offerings, regional, the discussions that are being held both at the shareholders level and at the board level. And it's an area that when the opportunity time comes, we will definitely deal with it. What we are building now is to make sure that we strengthen our balance sheet in our operations today, to make sure that we also retain our earnings, especially on the shareholders front, build a very resilient balance sheet before we start thinking of going outside. So those are on the table at the moment, but at the same time, we are building a resilient bank, very strong to its roots before we deliberate to go out of the shores of country. Thank you.
Thank you. So please, I have a question on if you tell us about your USG, what you are doing on ESG, and your reports and all the activities that you're embarking on ESG. Since USG is now a big issue in the corporate world, if you can share with us what CalBank is doing in that area, that space. Thank you.
CalBank have taken ESG as a very strong and a major focal point in our operations. And what we have done is that, first of all, before we start pushing that ESG agenda to our customers, we ourselves look into it introspectively and decided what we needed to do. Today, we are in a head office where we are EDGE certified. Almost 45% of our energy that we done is purely harnessed from the solar panels that we have in the head office. Our water is actually fully dependent from a borehole. Those are things that we have done ourselves to be making sure that we are environmentally sustainable bank. Based on what we have achieved ourselves, we have now transitioned it to our customers. Today, we have funded projects and provided loans on sustainable projects to most of our customers. And we have done that in conjunction with AFD, who has been our strong partner to be able to achieve that. In recent times, the last 2 months ago, we have inaugurated 3 major projects that we have participated in to be able to provide sustainable growth in terms of environment to our customers. And this is an area that we are working at every day, seeing opportunities to be able to make sure that we make relevant contributions to the environment and a sustainable level. Thank you.
Thank you. So there's a question from Joseph Sam. As shareholders, we appreciate the opportunity to engage with management today to make this Q&A as productive as possible and allow us to ask more informed questions. Will management be willing to share the key highlights from the annual report now? Specifically, the headline profit figures, capital adequacy ratio, NPL ratio, and dividend position, rather than waiting until after the session. Having those numbers in front of us will significantly improve the quality of the dialogue and demonstrate the transparency that builds long-term shareholder confidence. Okay, so there's a question from Joseph Sam.
Yeah, Joseph, we publish our numbers all out. It's on our website the last 7 to 10 days. And those are the numbers we are speaking to. When you get access to our website, you see all our financials performance being there. So the adequacy ratio and the NPL, as the CFO also presented, mentioned those figures as part of our presentation. But we can engage you further if there's any need for you looking for further information and detailed analysis. And we are willing to provide it to you as quickly as possible. Thank you.
Thank you, Mr. Sam. I think Joseph Sam is happy with your answer, and he's responded by saying that responded by writing that it's great. He's happy to hear your answer. So, yeah. So Joseph, so please check the website of CalBank, and I'm sure you find all these figures there. Thank you very much. Yeah. We don't have any more questions in the chat box. Our audience online, are we done with all the questions and the comments as we wrap up? Okay, I think it's been a very engaging and interesting session. If we don't have any more questions coming, it's been very interesting and the questions have been very packed. And I think the executives from CalBank have done justice to all the questions and responded to all of them. And somebody is asking, I'm sure this will be the last question, can dividends be paid in shares? This should be the last question from Caleb Amafiu.
Yeah, Caleb. No, for now, that is not part of the strategy. So dividends cannot be paid in shares.
Okay. On this note, thank you very much, our audience and the CalBank team. So I'll now give Mr. Asem the opportunity to share with us his final works, and then Mr. Frank Bell, our Deputy MD, will give the closing remarks. So, Mr. Asem, please, your final remarks before we move on to the Deputy MD of GSE. Thank you.
I think once again, I would like to thank all of you who have joined us on this call. We sincerely appreciate your time that you have spent with us to understand your cherished bank. We want to thank the Deputy Managing Director and the entire leadership team of Ghana Stock Exchange for making this platform available for us to be able to engage all stakeholders who have been interested in CalBank and this growth trajectory. As I've said in my remarks, opening remarks, this is a story of resilience. This is a story of renewal growth. This is a story of rebuilding back. This is one of our indigenous institutions that we are holding it to make sure that they are always best practice in corporate governance, by ability to generate the right revenue with the right employees, doing what is best practice in terms of governance ethically, and also demonstrated that. And we are on a very interesting trajectory. We are engaged, all of us, to be able to participate in this journey, watch how this bank is growing, and we'll definitely get there. We know our shortcomings where we need to improve upon it. We have heard of you as well in terms of our comments, and we'll definitely make sure that we deliver the right so that each stakeholder who has a stake in CalBank will benefit out of it. Thank you very much.
Thank you very much, Mr. Sem and your team. We'll now take the closing remarks from Mr. Frank Bell, the Deputy Managing Director of the Ghana Stock Exchange. So, boss, over to you. Please unmute. We can't hear you. Please unmute. We still cannot hear you.
Yes, can you hear me now?
Yeah, we can hear you now.
Okay,
Please go
thank you
ahead.
very much, Jerry. Good. What's the time? Good morning to you all, ladies and gentlemen. Respectfully, kindly grant me the permission to stand on the protocols as established to give my short closing remarks. On behalf of the Ghana Stock Exchange, I would like to express my heartfelt gratitude to the CEO of CalBank, Mr. Kalasem, and his entire team at CalBank for today's insightful presentation. Today's session has been tremendously very valuable, offering stakeholders and the wider market a clear picture of your financial performance, key operational achievements, and the promising road ahead. As it was indicated by one of our questioners, says the story behind the numbers are quite compelling. As one of our key listed companies and the cornerstone of Ghana's fast-moving bank, your enduring legacy and brand heritage speaks for itself. It is therefore both encouraging and inspiring to witness your steadfast commitment to growth, sustainability, and meaningful stakeholder engagement. This engagement is a true reflection of these values in action, and we commend CalBank PLC for championing this culture with such consistency and purpose. As investors may be aware, CalBank PLC's consistent compliance record is one we at the exchange hold in high regard. And the exchange continues to commend your unwavering adherence to our continual listing obligation, including appearing on our Fact Behind the Figures platform. This is what we as an exchange, we wish all our listed companies will do, and to emulate the good example of CalBank in this direction. This expectation, Mr. Chairman, is born on the point that the Facts Behind Figures program is part of GSE's effort in deepening information flow between our listed companies, investors, and analysts. This, we believe, contributes to disclosure, transparency, which is the hallmark of capital markets, price discovery, and market efficiency. As an exchange, we know that investors are interested in deepening the market. We have not relented in our effort to introduce new investment options for our stakeholders. It is in this direction that I extend invitation to all stakeholders to join us tomorrow, Wednesday, April 2026, as we organize a program at the exchange to list a new company, Zen Petroleum PLC, to give investors one additional option to participate in our market. Kindly permit me to give you some information about some few highlights of the market. Last year, our market had impressive run, and this year we are on the same trajectory. As was indicated by the CFO, CalBank PLC shares started the year at 0.64, and as at yesterday, 20th April 2026, it was 0.86, representing about 34.38% year to date. As it is normally said in our local parlance, let me give you the broad performance of our equity market. Again, as at yesterday, the equity market closed with GSE Composite Index returning 63.34%, and the Financial Stock Index recording a gain of about 83.something%. As an exchange, we are happy with this performance, and we wish that this performance is sustained. But as we encourage all market participants to be professional, astute, and conduct themselves appropriately to protect the sanctity of our market, we at the exchange, we promise to do our best in this direction. Once again, my appreciation goes to Team CalBank, the CEO, Kalasem, and the executives and all the team, including all participants of this program. Your active engagement in today's program has undoubtedly made it a success. Thank you very much. Go continue your good works. All the best.
Mr. Bell.
Thank you very much, Mr. Bell. And once again, we want to say a very big thank you to Mr. Kalasem and the CalBank team for this elaborate and comprehensive presentation. Once again, we thank everyone for joining this morning's call. I think this is the first behind the figures for the year for GSE. So kudos to CalBank for starting it for us this year. We are really grateful. Once again, we want to thank everyone who joined, our stockbrokers, fund managers, pension fund managers, corporate trustees, and our media partners, our academic fraternity. We thank all of you for joining us this morning, and we look forward to seeing you again soon. So once again, thank you very much. And if you have any questions, you can send it to investorrelations@calbank.net, and they'll be happy to respond to any concerns that you have. And if you also have any questions for the GSE, you can also send it to info@gsc.com.gh, and we'll be happy to respond to your concerns. Once again, thank you very much, and wish everyone the very best for the rest of today. See you soon. Bye-bye.